How does inheritance tax actually work in the UK? Inheritance tax is payable on your net assets when you pass away. It is payable by people who die as a UK domicile. After the 6th of April 2025 onwards, it is done in a residency-based system where if you were a resident in the UK for the 10 years prior to your passing, your estate will be subject to UK inheritance tax. Inheritance tax is payable on your net assets when you die, so that is your assets minus any liabilities. So for example, if you owned a home that was worth £400,000 and had a £100,000 mortgage on it, you would pay inheritance tax on £300,000, the net asset. It is payable when your estate is worth more than £325,000, and the inheritance tax rate on the vast majority of assets above that threshold is 40%. So your estate will pay 40% to the government on the assets above 325,000. More estates are affected than people think because it includes absolutely everything you own, including your family home, which, especially if you live in the southeast of England, will usually take you up to the threshold all on its own. The most common way to plan against inheritance tax is to gift your assets away to your beneficiaries before you pass away. There are small gifts that you can make. For example, you can give £3,000 of annual gifts to anyone you want. They immediately fall outside of your estate, not subject to inheritance tax. There are also special gifts that you can give to people when they get married, the amounts of which are dependent on if they're your child or your grandchild. And there are also special gifts that you can give, just small gifts to other people, and gifts to charity as well. They fall out of your estate the second they leave your bank account. For gifts bigger than that, you often have to wait 7 years for them to fully pass out of your estate. So if you gift £100,000 to someone who you would otherwise want to be a beneficiary, and you live for 7 years, that then passes out of your estate in full as well. If you pass away within the 7 years, the £100,000 has usually tapered off somewhat. So instead of paying the full 40% inheritance tax on the 100,000, you'll pay a sliding scale for as long as you've lived beyond making that gift. The residence nil rate ban came in with David Cameron's first government, where he made a pledge in the election that if you owned your home and your home was worth less than £1 million, it would fall outside of the scope of inheritance tax and you could pass it on to your kids with no inheritance tax. And the way that comes about is you have the £325,000 nil rate band. You have that for both you and your spouse, totaling £650,000. And then on top of that, you have a residence nil rate band, which is £175,000 each, totaling £350,000. 350 plus 650 gives you the £1 million that meets that election pledge. Whereas your nil rate band, the £325,000 each, is available to use on any of your assets. The additional residence nil rate band is only available if you are married. By default, when you pass away, your assets will all pass to the surviving spouse. No inheritance tax is ever due on that transfer to the surviving spouse. When the second surviving spouse then passes away, you can combine your nil rate band and residence nil rate band, the £650,000 combined and the £350,000 combined, giving you your £1 million if your home is worth over that, when it then passes down to the next generation. Two main exemptions from inheritance tax in the recent past were farmland and small businesses. Farmland fell outside of inheritance tax, however big it was, under what was called agricultural property relief, and small business owners were able to pass their businesses onto their beneficiaries outside of inheritance tax as well, with business property relief. However, in the recent budget in October 2024, Rachel Reeves removed those exemptions, making both of those assets at least partially subject to inheritance tax, even if they're at a lower rate than the 40% available on other assets. Setting up a trust can help to reduce inheritance tax, and there are pluses and minuses to that. When you move an asset into a trust, it does fall outside your estate and therefore doesn't subject your estate to the 40% inheritance tax, but there are other ramifications of tax inside the trust that need to be considered. So it will have to be discussed on a case-by-case basis. In some cases it can be very beneficial, and we do recommend it in the right circumstances. Absolutely all of your assets and must be considered when we discuss your inheritance tax planning. That can be your home that you live in, your cash, even if it's held within an ISA, any shares that you own in any companies, any land that you own, any other homes, anything else you can think of that you consider an asset that you own, most likely should be part of this conversation. In particular, the rule changes around your pension, which is most likely your second largest asset beyond your family home, has now become part of the conversation. It used to fall outside of your estate to your next generation in most circumstances. However, nowadays it is included as part of your estate, and that was part of the recent budget changes. This is a very major change. If you have a pension that was worth £100,000 and you wanted to give it to your children to then draw on, they would only be taxed once when they come to draw the pension as income. However, now we have a situation where that £100,000 will immediately be taxed at 40%, reducing it to £60,000, and then when they draw it as income again, the next generation will pay income tax at their marginal rate, which if that's 40%, that's another £22,000–23,000 off that, meaning that your £100,000 pension has been reduced down to £37,000 by the time it hits your beneficiary's bank account. If your estate has a net asset value of greater than £2 million, you need to be wary of the tapering of your nil rate band, which is that £650,000 that was initially tax-free. That goes away over time as your estate grows beyond the £2 million mark, as well as being subject to 40% tax, which leads to an essentially a marginal rate of 60% inheritance tax as it's tapering away until it's all gone.